I've just worked through question 1 from the September 23 ACCA mock exam. Pre-populated P&L, with foreign currency, with hedging, quite a tricky question. And I've worked through it as I would like you to work through it. So I've demonstrated in this debrief exam technique. I've demonstrated just moving on. My answer is not perfect. I haven't set out to produce a perfect answer. I have tried in this example to show you what you can achieve. This is, I've marked it, I've probably marked it fairly harshly, but I haven't got 80% in this exam, in this answer. But what I have done is I've not overrun on time. What I have done is I've picked up the low-hanging fruit. What I have done is to explain what I have done. The ACCA have a model answer, and by all means you can refer to that as well. But this is my live answer to question 1 from the September 23 ACCA mock exam. Question 1, Fewston.
Let's have a go at this question. And this is where we start, at the beginning. And the opening information blurb here, I don't think there's a lot really that you need to pick up on. Your year end is 30 June X1. All right. And that's important. You've got exhibits, and there are 5 of these exhibits. I haven't got the brain space to open them all up and read them all up. Yeah. The first thing that I really want to do is open up the requirement. And actually, although I do want to read the requirement, that's crucial. The first thing I want to do is Control C. Yeah. Copy and paste that into my Word response area, and then do a little bit of editing. All right. So I'm showing you exactly how I'm approaching this question. This is a combination of exam technique, time management. Yeah. So you're just going to occasionally have to bear with me, because I'm not going to edit out all the fancy little stuff to make it look smooth. This is real. Yeah. It's a 30-mark question. We've got about an hour to play with this. And you can see in the requirement of the question that references are being made to the exhibits. Yeah, it's very clear and transparent that in part A, we're using exhibit 1. Yeah, in part B, we're using exhibit 2. And oh my God, in part B, we've got hedging, or whatever. And in part C, we're using exhibit 3 and 4. All right. So we've got these exhibits on the left-hand side here. The draft consolidated balance sheet, strictly speaking, you don't need to open that as such, because that information is just replicated within your Word spreadsheet response area. I want to answer this question as I would want you to do it. And that means not reading all the exhibits first. It means doing the first part to the first question. And we've got to calculate the exchange difference. Yeah, we've got to calculate an exchange difference, and we've got to explain how that exchange difference would be presented. All right. We've got to explain how that would be presented. And there's 6 marks for doing that. So there's, although the word "and" isn't in there, there's 2 things we've got to do. And then we've got to discuss how the recognition takes place, and we've got to make reference to the framework. So there's 10 marks available there. Maybe there's more marks than 10 marks actually, because I want to do the question holistically. And although I can see in part C of the question, as I would expect, using the pre-populated spreadsheet, prepare, I'm going to do that as I go along as much as possible. All right. So it's kind of okay if I get a little bit behind in terms of the time, but I want to give you a realistic answer using exhibit 1. So let's have a look at exhibit 1. Let's see what we are being asked to do in exhibit 1. And exhibit 1 tells us quite a few things. That we've entered into 2 transactions that have been denominated in a foreign currency. Now, one of them is at the beginning of the year, we bought a sub. And we've got the goodwill of the sub. And NCI has been measured as a proportion of net assets, and we've got the net assets. So one of the things we've done is we have, we've acquired a sub, and there will be exchange differences arising in respect of that. The second thing we've done is we are Fewston, we've bought some goods. So the second thing we've done, is that we have bought some goods. And we're being tasked for 6 marks to calculate an exchange difference and explain how they would be presented. And then we've got all of these exchange rates, and we're told here in this final sentence, nothing's been done. So we're not having to unpick incorrect numbers, we can just proceed. So when we have an exchange difference on a sub, that will be presented in equity, that will be presented in the group other comprehensive income. So I can say here on the retranslation of the goodwill and net assets of, and let's use the name of the subsidiary of L Arabol. On the retranslation of the goodwill and the net assets of Arabol, the exchange difference, good or bad, the exchange difference will be presented in other comprehensive income. And I think OCI is a reasonable abbreviation. It is a well-known one. So let's calculate that number. Now, you could do it in a spreadsheet, but I don't think it's a complicated thing to do. We've got a 90% sub. We've got goodwill of 6.1 million. So we've got an exchange difference arising on the retranslation of the goodwill. We've got HD, and we have got HD, let's put it in thousands. Let's put it in thousands. And we have got here 6.1. Now, the point of that number is that last year it would have been translated at the opening rate, at last year's rate, which is $1 to 9.2. 9.2 hem dollars is a big number. So if we're turning the big number into dollars, we're having to divide. So we're going to be dividing that. We're going to be dividing that by 9.2. And we're then going to be taking the 6.1 at the year end. It's not been impaired. And we're going to be using the closing rate. And the closing rate is given to us at year end 30 June X1. The closing rate is 10. The closing rate is 10. So I can do 10 in my head. So that is 610. That's not a problem. And then we will have an exchange difference. And what I'd now like to do is get out my calculator. And I don't really like scientific calculators, so let's have it as a standard calculator. And we're taking here 6,100, and we are dividing that by 9.2, and the figure we are getting there is 663. 663. And remember, this figure of 663 is in dollars. And is in thousands, and therefore we've got a difference there of 53. This is goodwill, which is getting bigger. This is the retranslation of goodwill, which is getting bigger. So therefore this represents an exchange gain. Now this will go to equity. What we've got is goodwill calculated with NCI as a proportion of net assets. Now that means the goodwill is attributable to the parent company only. This means that goodwill is attributable to the parent company only, so none of that will go to NCI. So we can cheat slightly. As the non-controlling interest was measured as a proportion of net assets, goodwill is wholly attributable to the parent. none of this gain will go to the NCI. None of it is attributable to the NCI because the goodwill isn't attributable to the NCI because NCI has been calculated as a proportion of net assets. Now, you will also have an exchange difference arising on the retranslation of the net assets themselves, because when you've got an overseas sub, the net assets are retranslated at the closing rate. And again, what we've got given to us in the question is the numbers. So the net assets had a carrying amount of 49.9 million. So in terms of the opening balance of the net assets is 49,900. Yeah. And that would be translated at the opening rate. So that is going to be translated at 9.2. Whereas we do know at the end of the day, their net assets are a bigger figure and they will be translated at the closing rate. They will be translated at the closing rate. So the closing balance of those net assets is given to me in the question there at 53.6. 56.3. God, a bit of dyslexia creeping in there. And that's going to be translated at the exchange rate of 10. And therefore, I know in terms of my dollars, that's coming in at 5,630. So we can kind of, build up our answer as we go. Now, profit, although the opening assets are translated at the opening rate and the closing assets translated at the closing rate, the profit for the year is translated at the average rate. So the profit for the year, first of all, is a balancing figure. I'm not given it. And secondly, it's going to be translated at the average rate. So let's just leave a little bit of an explanation as to what we're doing. And you don't need a calculator, surely. You can see that that's nearly 50,000. So that's 6,400. Yeah, is the profit for the year. Now that profit for the year is translated at the average rate. We're making the big number smaller. The average rate for the year is 9.3. If I'm going to get my calculator out, if I'm going to sort of do some numbers, let me do some numbers right at the end. Yeah. And my final thing in terms of setting it all out, this exchange difference. Yeah. This is the balancing figure. This is the balancing figure. So where's my calculator? Yeah, I need to leave an audit trail because obviously the marker doesn't see what I'm putting into my calculator. 9,900. We're dividing that by 9.2 and we're getting a figure there of 54. So we're dropping that number in there at not 54, it's 5,424. Yeah. Let's not quibble over decimal places. 6,400. We're dividing that by the average rate, which is 9.3. And therefore, that's giving us a figure of 688. So the profit for the year goes through at 6.88. And therefore, if we add that to the opening balance of 5,424, you should be arriving at the figure that we had expected. So if there was no exchange difference, the net assets would have been 6,112, but the net assets are a smaller number and they are only 5,630, and they are that smaller number of 482. So that figure of 482, is a smaller number for goodwill. And that smaller number, no, that's a smaller number for net assets, isn't it? So that is a loss. That is representing the exchange loss. Now, I want to do the question holistically, which means a couple of things. So first of all, my overall loss is the aggregate of these two numbers. In other words, it is 53 plus 482. And if I add the 53 and the 482 together, I can do that in my head. That is 535, and that is going to OCI. But part of it will affect the NCI and part of it won't. So the NCI are only going to be entitled to, are only going to suffer. Hang on a minute, that's unusual. I'm talking about one's a gain and one's a loss. Is that right? That wouldn't normally be the case. The assets here of goodwill. There we are. Look, let's go through. You're being real. You're watching me working. That's an exchange loss, isn't it? Because the goodwill has become smaller. Yeah, the assets have become smaller. You would expect them both to be operating in the same way. So they're both exchange losses. Now, the non-controlling interest doesn't have an interest in the goodwill. Yeah, the NCI doesn't have an interest in the goodwill. So the NCI will only have an interest in the exchange difference of 482. So although to do with the net assets, so although I can, calculate that in my head, I do think that one is worth showing. And the parent, what's a parent is the parent will obviously suffer, that's the right word, the difference of the 535 and the 48. Do I want to risk that doing in my head? Perhaps not. So let me just put that in a calculator, and in my calculator, 535 minus 48, and 535 minus 48 is 487. Now, I want to do the question holistically. I've got to do as I say. I'm going to try and be good. And that means I'm going to be putting these numbers in the spreadsheet as I go along. I'm not going to wait until the very, very end before doing part C of the question. I think you want to have a separate column for each adjustment. And this is to do with the group. And this is to do with the group foreign exchange. And we know it's a loss. And overall, that loss is 535. Excuse me. Overall, that loss is 535. It goes in OCI. And it may be reclassified to the profit and loss account. So we're putting in there 535. Yeah. If we wanted to expand the exchange in OCI, it may be reclassified if we wanted just to add a little bit of extra something there. Now, that 535 in OCI, that is partly attributable to the parent, total comprehensive income, partly to the parent, partly to the NCI. And as we have sussed out already, the split of that, the NCI is only suffering from the share of the net assets, whereas the parent suffers 90% of the net assets, but 100% of the goodwill. And that is a figure of 487. That is a figure of 487. So I'm very comfortable there that I'm earning my marks. And even if my calculations are wrong, I will still get the marks for part C for putting them in the right place. Yeah, really important that you show your workings, and then you put whatever comes out of your workings into the pre-populated spreadsheet, and you get a double win. Yeah, you don't get a double penalization. So really important that you kind of keep going. Right, I'm conscious that time is slipping me by, and I'm conscious that I haven't finished the first part of this question. And I bought some goods. Now, what goods have I bought? I have bought some goods on 60 days credit, 12th of June, and the year end, the amount has not been paid. So, yeah, the goods, the transaction is translated at spot rate. The transaction is translated at the spot rate. The year end liability retranslated as a monetary item at the closing rate. and the exchange difference, what was the wording of the question? Presented in P&L. Now, strictly speaking, the standard never tells you exactly where to put it, but this is to do with the purchase of goods, and therefore I'm going to suggest that we put it in the cost of sales because it's an operating activity. So let's calculate that exchange difference. We have got a figure of 430,000 HDs. And in the first place, that is going to be translated at the spot rate. And that was on the 12th of June. And the 12th of June, it was 9.8. So that will be the initial recognition of the liability. That will be the initial recognition of the liability. But as a monetary item, that is retranslated at the closing rate. And the closing rate is 10, and I can do that in my head at 43, and therefore we get an exchange difference. We get an exchange difference. So I need a calculator at this stage. So let's clear the calculator. That is 430, and if we take 430 and we divide that by 9.8, and if we divide that by 9.8, we get 43.8. I need to call that 44. So if I get that at 44, I then have an exchange difference. This is a liability. The exchange difference is 1. The liability is being retranslated and the liability is getting smaller. And if that liability is getting smaller, I think that is a good thing. Yeah, and I think that is therefore a gain. And there is no impact on the NCI as this is a transaction of the parent, So I'm taking that exchange gain of 1, I'm taking it at cost of sales, I'm putting it in there straight away, bish, bash, bosh. So here I go, pre-populated spreadsheet. This is a gain. So this is the gain on the cost of sales on the foreign currency, on the retranslation of the liability. That'll be enough, and it's a gain of 1 in this language because everything's in zeros. So I show that as a positive number because that would reduce the overall cost of sales. Yes, good, right. Holistic. Forward contract, so help me God. What is going on here? All right, so, it's not perfect, but I think it's good enough. Oh, I haven't dealt with the second part. Discuss how the changes, discuss how the changes are recognized, referring to the requirements, of the conceptual framework. 4 marks. If you write nothing, you will get no marks. The conceptual framework requires information to be useful. Yeah. Where are the exchange difference recognized? The exchange differences at the group stage are recognized in equity, but for the individual company in the P&L. Maybe that's just worth 1 mark. It's not a great discussion, is it? But it's better than nothing. The fact that you've got these exchange differences recognized in both, maybe that's a little bit confusing. Yeah, this is potentially confusing for users. What does the framework say about where gains and losses should go? Well, the default is it should be in the P&L. Yeah. So the conceptual framework has a default that gains and losses are reported in the P&L. So why would they be in OCI? Why would they be in equity? According to the framework, it's because the information should be useful. Yeah? The conceptual framework has a default that gains and losses are reported in the P&L. They are only to be included in equity, i.e. excluded from P&L, but presented in OCI if it is more useful to do so. Ha! Yeah? Now, if you want to polish this off a little bit more, you could say that useful means that it is relevant and a faithful representation. I do think this is worth a couple of marks. However, partly because I'm a bit of a show-off, but maybe this is something that I can add a bit of value to and I can carry on a little bit more. You know, why are we taking group exchange differences to equity? I don't think they should be included in the P&L. So group exchange differences are long-term, unrealized, and likely to reverse. Yeah, they're not a pattern. There's not a pattern. All right. So they are not predictable. They're not predictive. They don't give a user, if a user looks and sees that an exchange loss has been made this year, it's not a guarantee that an exchange loss is going to be made next year. The exchange rate could bounce back up again. So exchange differences are long-term. They are unrealized. They are likely to reverse. There's not a pattern to them. Yeah, they're not operating activities. So they are not predictive. So it is not relevant to include them in the P&L. It's not useful to include them in the P&L. Yeah, because they're not of a predictive nature. So it is not useful or relevant to include them in the P&L. Yeah, but the individual transaction is close to being realized. Yeah, you're going to settle that liability very quickly, is close to being realized. Yeah, is of an operating nature. So in other words, it's a day-to-day, it's a short term, it's a day-to-day transaction. So is best included in P&L. Yeah, look, I could go on, but I'm a bit worried about the time. Yeah, time management is key. If I only get 3 out of 4 for this, it's not the end of the world. I want you to get something from every part of the question. So we're discussing how exchange differences should be recognized. I am moving on. Clearly, a perfect answer or a model answer is going to have a little bit more to it than that. But hey ho, we move on. We move. Using Exhibit 2. Using Exhibit 2. Discuss whether Menwith is correct to apply hedge accounting. explain how they should account for the hedge. So the first part is all about discussion. The first part is all about a discussion. And are they correct to apply hedge accounting? The second is explain how they should account for hedge accounting and calculate some amounts to be recognized. So that's quite a lot, but mind you, it's 9 marks. If it's 9 marks, that's what, 17 minutes, 18 minutes, something like that. You've got a bit of time. Our year end is 30 June. So when we enter into a transaction in May X1, it's just before the year end. And we're going through a 75% sub. So therefore, the NCI will be impacted by any additional gains or losses. Now, this company has signed a new contract to buy a plant in Whitmark, and this is payable in August X1 after the year end. So we've got a firm commitment today, this year end, to buy this asset, to pay for this foreign currency in the future. Now, we've got a risk management policy and we are hedging by entering into a forward contract, and we've prepared the appropriate documentation. All the rates are given, no accounting entries have been made. So we're not unpicking anything, and we're having to discuss whether Menwith is correct to apply hedge accounting. Well, I don't like the question. I mean, I don't like the fact that it's on hedge accounting. I mean, we're told it's a fair value hedge, by the way. We've got the statement that it's a fair value hedge. Discuss whether they are correct. Hedge accounting is optional. Hedge accounting is an accounting policy choice. In other words, even if the criteria are met, even if the conditions are met, Menwith can still not apply hedge accounting. It has that choice of doing so. Now, you can only apply hedge accounting if the conditions are met. You can only apply if the conditions are met. Now, I don't want to get too technical here. I just want to keep it simple and keep it applied. In order to hedge, you have to have a risk. Yeah? There has to be an eligible risk. There has to be an eligible risk. And the hedged item is this commitment, which we've got. The hedge item is the commitment, to pay in a foreign currency, after the year end. So we are exposed. We have a risk. And if you're hedging, you're covering that risk. So first of all, you have to have a risk. There also has to be a hedging instrument. Now we've got a hedging instrument. This is the forward contract. This is the hedging instrument which is designed to be efficient and designed to cover that risk, to fix the price. And it has to be an effective hedge. It has to be an effective hedge, and I think we've got that. And it all has to be documented. Further, it has to be documented. It has to be documented. You cannot hedge retrospectively. You've got to go into the derivative knowing why you are entering into it. Further, it has to be documented. Menwith has done all of this. Menwith has met all these conditions. And therefore, hedge accounting is applicable. Yeah, if it wants to. Discuss whether Memwith is correct to apply hedge accounting. Well, it can if it wants to. Yeah, it can if it wants to. So it is correct. So it is correct to use hedge accounting. So we're discussing hedge accounting in a broad sense, but we're applying it to Memwith, because the second part of the question is how they should account for the hedging arrangement, and we've got to calculate the numbers. Well, how they account for it slightly depends on whether it's a fair value hedge or whether it's a cash flow hedge, but we're told it's a fair value hedge. Now, the derivative that we've entered into, and we know when we've entered into it, we've entered into that derivative on the 12th of May. Yeah. So, you know, the derivative is entered into on the 12th of May. No, nothing is recorded. Yeah, nothing is recorded. A derivative is a contract that you enter into at little or no cost. So on initial recognition, nothing is recorded at that date. But it must be remeasured to fair value. It must be remeasured, but it must be remeasured, yeah, to fair value at the reporting date. Look, am I going to get 4 out of 4? I don't think so. But I'm getting my low-hanging fruit. I'm getting my easy mark. Yeah, I'm getting my easy mark. As a fair value hedge, the offset of the gain stroke loss on the liability in this case and the forward contract are both paired, are both matched in the profit and loss account. Now, I've done a bit of explaining, calculating. OMG, I'm scared. Those numbers really don't do it for me. I'm very conscious of time. I'm teaching you exam technique. We move. All right. I'm not going to bother trying to calculate it. I wish the number was given to me and therefore I will be able to use it. So yeah, this is not a perfect answer, but it is an answer that I'm doing for you, unedited, in the time allowed, trying to explain what I would do in the exam in order to pass the exam. All right, so what else have we got? Because we've only looked at 2 exhibits. We've got the third requirement, which is using the pre-populated spreadsheet. Have a look at exhibit 3 and 4 and prepare the consolidated statement of profit and loss account and other comprehensive adjustments made. So we've got to have a look at Swinsty, and we're not writing any answers, are we? No, we're not writing any answers, so we can now get rid of that for now. We're looking at the acquisition of another subsidiary, and we're wanting to process numbers on our spreadsheet. I guess that's what we're about. So what's going on? We've acquired 80% of the shares of Swinsty back in January XO. Okay, some time ago. It's 80% sub. We've got administration offices, and there's a fair value adjustment. Now that presumably was correctly taken into account in the goodwill and whatever, but that's not really what we're about. The average remaining useful life was 20 years. So what we've got here is a fair value adjustment, which makes the asset go up. Because the asset goes up as a consolidation adjustment, we've got to, as a further consolidation adjustment, have additional depreciation. And this is in respect of a office, so administration. We've also got some intercompany sales, and we've got an unrealized profit. We haven't got to calculate the unrealized profit. It's given to us, so there's no need for a markup margin story. And then we're told about tax rates at 20%. You might want to ignore that. I'm not going to. I'm going to pick up the hint that there's a deferred tax consequence to depreciation and to PUPs because they affect the carrying value of the asset, but they don't affect the tax base of the asset. So there is a deferred tax implication which has a matching process through the P&L. So I think we ought to do a little bit of a working here. To show our workings and to partly slow me down. And the first working I think we're going to have is in respect of the depreciation, and this is in respect of Swinsty. So what we've done is we've got an additional fair value adjustment of 2,500, but this is going to cause additional depreciation to be charged over 20 years. Now, if that was over 10 years, that would be 250. So we've got an additional depreciation charge of 125. Now, I can't help myself. I'm kind of greedy, and I'm thinking I'm just jumping in here, depreciation. I'm putting in there an additional depreciation. I'm going to assume that's part of it's administration offices, isn't it? So it's part of operating expenses. I've got additional depreciation there of 125. That's an extra expense. There's a mark. Now, if that's all you do, well done. Well done. But there is a deferred tax implication to what is going on. So there is a tax implication. And the deferred tax implication is at 20%. Yeah, because we're told the tax rates are 20%, which is a fifth. So the tax implication of that is 25. Now, if we were reporting an additional gain, there will be additional tax on that gain. The gain would have increased the carrying value of the asset and would create a taxable temporary difference. This is the opposite here. Yeah, we've put through an additional expense of 125. So therefore, which is not getting tax relief because it's depreciation. So we're getting this deferred tax kickback of 25. All right. Now that means the net effect, the net expense that you're charging, is 100. The net expense that you are charging is 100. So when you come to think of how this is going to affect your NCI, because it does affect your NCI, you're affecting this in the books of the sub, and it's an 80% sub. Yeah. So we've got a net effect of 100. It's not in OCI, but it will affect the NCI. This is going to affect the profit for the year. This is going to affect the parent by 80, and this is going to affect the non-controlling interest by 20. And if it's affecting the profit for the year, then ultimately, it also affects the total comprehensive income attributable to both. Ultimately, maybe we should show a working. So this is an 80% sub, and because it's an 80% sub, then we have here to the parent, this is going to be 80, and then to the NCI, it's going to be 80% sub, so it's 80% of 100. It's not because I can't work it out, is I want to leave an audit trail in case I'm using the wrong number. Yeah. So 20% to the NCI. So look, I'm leaving it there. 20% to the NCI. Right. I am still on Fewston. And we also have an intercompany sale here of 1.9 million. All right, so we've got an intercompany sale here of 1.9 million, and there's no written explanation, but the single entity concept applies. You've got to remove here the intercompany sale, and you've got to remove here the intercompany purchase. So who is the selling company? Fewston. The parent company is selling to the sub. So you're knocking out that intercompany sale that has no impact whatsoever on overall profit or on NCI. So it's a very simple thing to do. Now we've got an unrealized profit because the subsidiary hasn't sold on their goods. We have reported that profit of 80. And so there is a PUP. There is a provision for unrealized profit. And that is an additional expense, yeah, that we need to have charged against profit. So costs of sales are going up. That is an additional expense. Now the person who made that profit was the parent company, and therefore there is no charge to the non-controlling interest as a result. So it doesn't affect OCI. That does affect here the provision for unrealized profit. It does affect there the provision for unrealized profit. Bish bash bosh. There it goes. And obviously anything that affects the profit for the year affects the total comprehensive income as well. All right, so minus 80 goes there as well. And I pause because I've made a mistake, haven't I? I've ignored the tax implication of that 80, haven't I? Yeah, so there is a tax implication on the 80. Yeah, because you're not going to get tax relief on that 80. You're changing the... So this is getting technical, isn't it? But there is a tax implication on 20% of that 80, which is therefore a difference of 16. All right. So actually, this figure here should be a net figure of 64. And this here should be a figure of 64. You're seeing me work this question. All right. You're seeing me sweat. If it was an additional gain, I would be putting in an additional tax expense to match with the gain. But this is a loss for which we're not getting immediate tax relief. This is a loss. The PUP is a loss, and therefore the deferred tax on that loss, you are creating a credit to the taxation. Yeah, you're getting tax relief in the future. So the net effect there is 64. No impact on the non-controlling interest. No impact on the non-controlling interest. Good. Right. Where am I? I still have some time left, I think. I have looked at scenario number 3. What I haven't done yet is to process scenario number 4. And scenario number 4 says... The draft consolidated profit and loss account and OCI has been prepared by adding together the income and expenses. Yeah, fair enough. You've done that. No further adjustments have been made. However, in each case, the relevant proportion of the subsidiaries... I don't think I've got anything to do with that. I don't think that affects me. Maybe I should have read that at the beginning. Maybe it should have been presented at the beginning. But it doesn't affect anything that I have. That exhibit is the spreadsheet. Now... Time management. All right. I am tempted to produce a final answer. I am tempted to produce the adjusted answer, but do you know what? I'm not going to. I am not going to, because there are no additional marks for producing a final revised answer. Do not waste your time, yeah, filling in all these numbers. Please do not. The marking guide, the marking is going to be based on these numbers. And in fact, what I would like to do now, yeah, is just to briefly make sure that I have answered every part of the question. So let's go back. We had included everything in there. Yeah, we've done it. And I'm looking at my time and I've got a few minutes left. So I'm a tutor, so I'm able to basically bash through this question a little bit quicker than you do. But this is the sort of answer that I want you to be preparing. And what I'm going to do now is I'm going to mark this answer. So you can see on the right hand side there, I have introduced the marking guide. And for A Part 1, there was a maximum of 6 marks available, although in theory there were 7 different opportunities to earn marks. I actually feel very, I don't know what the word is, cocky or confident. I really think that I have calculated the exchange differences on the translation, on the goodwill. I've talked about their presentation. Yeah. And so for me, for A Part 1, I'm giving myself 6 out of 6. All right. I'm giving myself 6 out of 6. All right. Because everything verified. No impact as this transaction, or no impact on the NCI. Oh, I can't help myself. I did have a moment there on review. No impact on NCI as a transaction of the parent. Discuss how the exchange differences are recognized, referring to the framework. Now, interesting, you've got 7 marks available for this discussion, but the maximum out at 4. So there's a lot of judgment that the marker has. I've explained about useful information. I've explained how they're dealt with. This is not a perfect answer. Do I give myself 4? Do I give myself 3? If I'm being really harsh, I give myself 3. If I'm being generous, I might give myself 4. Yeah, I might say every point there is worth a mark. So you know, it's a judgment. I'm giving myself 3 out of 4. I'm being harsh. Part B Part 1, again, we got a maximum of 5 marks, but you've got there potentially 7 on offer. And I've only written 3 points. I've only written 3 points. So I'm going to be generous with myself this time, and I'm going to give myself 3 out of 5. I think each of those points is worth a mark. Yeah, I mean, maybe this middle point here is worth a couple of marks because I've said a little bit more, but I'm going to give myself 3 out of 5. I'm being quite a harsh marker. All right. And then here with this point, explain how the hedge accounting is being applied. There's no calculations. I was asked to do a calculation and there is no calculation, but I just took a judgment call that was like way tricky. I took a judgment call that was not pass or fail. I thought it was a time waster. I think I've earned myself. If I'm going to be harsh, I'll give myself 1. If I was going to be generous, I'll give myself 2. So I'm going to give myself 1 mark here. And then that's it. Until I get to look at the pre-populated spreadsheet. So let's have a look at the pre-populated spreadsheet instead. And let's see how the marking works in the pre-populated spreadsheet. Again, what you've got in the pre-populated spreadsheet is more marks available than you think. Maximum eyes at 11, 3, 6, 8, 3, 6, 8, 10, 11 and a half. So you're maxing at 11. So let's have I earned the exchange gain on the payable? That was the 1, wasn't it? Yeah. That was the 1. The 1.5 marks available for that. Yeah. And I can see that, I was a bit naughty, actually, because I got carried away there as an early one. That exchange gain of 1 should have, been affecting the profit to the attributable to the parent and should have been going in there as well. So maybe I've only earned myself half a mark. Yeah, I've missed out those 2 adjustments. The exchange loss on the retranslation, smash that one. So definitely got 2.5 there. Definitely got the 2 marks there. Hedge accounting, 0. Didn't do the numbers for the hedge accounting and therefore can't gain any of those marks. The fair value adjustment in Swinsty and the unrealized profit in Swinsty, 3 marks each. 3 marks each because of the deferred tax implication and because whether or not you're dealing with the NCI adjustment. And I smashed that. So I got 6, 3 and 3. I got 2, I got 8, I got 8.5. Let me just add up exactly how many marks I've earned in this question. Okay, I've just added up the marks. I've rounded up my 8.5 to 9. Remember, I was being harsh on myself. I have got 22 out of 30. That is 73%. I now have enough time to move on to the next question. Okay, I could have earned an additional mark if I had remembered to bring this down, which I normally do. I could have earned an additional mark if I'd done a little bit more on the hedging. Hey ho. Yeah, I worry sometimes that you are going to fail this exam because you do question 1 first, because you obsess with the numbers, and that you don't take a holistic approach. I have shown you not the model answer. I have shown you not a perfect answer. I have shown you my answer in the time allowed, well within the time allowed. JMO. Just move on.